Hey everyone, this is Rob Keynes of goldsilverpros.com. It is February 5th, 2021. I have a very special returning guest, Lior Gantz, owner of Wealth Research Group. Lior, how are you doing today?
I'm doing well. Thank you for having me.
So thank you for joining. Now, I know it's a little bit late your time, so I appreciate you coming on the channel, but I really wanted to speak to you because I know that your group does a lot of research on the commodities markets, the precious metals markets, and even the broader markets as well. And we've had a lot of excitement lately in some of the stocks, of course, GameStop and AMC, and then I think a movement spilled over into the silver market. So I wanted to get your thoughts on the silver squeeze and what you think about what's going on.
Okay. Um, it, it, I can start with the silver squeeze. I think, in general, if you look at silver as a market, the biggest buyers, loyal buyers of silver are baby boomers. And what they remember is the 1971 to 1980 period succinctly, where silver basically became a commodity that went from $1.92 when the gold window closed in the 15th of August 1971.
Mm-hmm.
And in 1979, you had two oil billionaires, the Hunt brothers, loaning about $3 billion in very low interest rates and basically buying as much silver supply as they could, where at the peak, they almost owned a third of global supply of silver warehoused. It's an incredible thing that they pulled off, but it was so it was such a dramatic accomplishment that the government intervened. If you think the Robin Hood scandal, where they stopped people from buying certain stocks and only allowed them to sell them, that's what the government did with silver. They banned long contracts; you could only short it. And then on what's called Silver Thursday, silver's price just tanked badly. And this is in 1980. I'm talking about with the Hunt brothers. And then the government arranged how they would unwind their position over the years. And so people have that in mind a lot. And then in the 2000s, around the 2008-2009 period, there was a lot of talk about how the silver market is being shorted or suppressed or manipulated. And that has proceeded for the past 10 years, where the CFTC has looked into how JP Morgan and other banks treat the COMEX. And what they've been able to find out is basically that traders in the commodities desk for these bullion banks, they do what's called phantom trading or spoofing, where they would just come in and let's say that they want to tank the price. They would create an order to sell a big amount of silver, but it will only be at a level 2 or level 3. You would not be able to see it if you're trading just the general markets. You would see it over the counter, and that would spoof big buyers on the other hand, and that will make silver drop. And on the flip side, if they want to get the price up, and they will show a big block, like they're going to purchase a big order, but they never do. That's why it's called phantom. Anyways, they got fined $960 million, as you know, just a couple of years ago because of this. And because of this, also some rules have changed. And now the CFTC has much more control over trying to squeeze the silver market. It's not so much the short. The short position on silver is not huge in terms of like with GME, where it was 120% or 140% of the flow. That's a naked short. That is insane. The interesting part about silver is that it's a concentrated short. So there's only like 8 to 12 big short positions out there by these institutions, and that's why there's a potential that if those institutions get scared, they'll need to cover those shorts. But I would say it's pretty much impossible at this point to short silver, or to do, not to short, to squeeze the short in silver, or to bid up the price by collectively buying a lot. There's all sorts of restrictions on how much you can buy, on the fact that they can settle with you for cash. It's not an easily influenced market. as GME was for a few days. So I would say that's not the proper way of looking at why silver would go higher from here, much higher, in my opinion, with the research that we've done. And you can go to wealthresearchgroup.com/squeeze, which is a special report that we created about silver. This episode of the short squeeze, I would say the failed short squeeze, and why silver can actually double from here, but not because of any squeeze. That would not be the reason why it will go up. What I think the most important takeaway for me from what happened last week is that now, where the baby boomers were the loyal silver bugs, now this is opened up to Generation Z and to millennials. Now they're fascinated. What is silver? What does it do? What's important about it, etc. To them, it's also a clean energy metal. So it also has this component of, hey, it's like lithium. If Tesla needs it, then etc. etc. So it has that industrial component to their bullish thesis. But they also are becoming aware of the national debt, of inflation. So this is really good in terms of opening up to a bigger sector of society. And I remind you, currently, 33% of American workforce is millennials. In 10 years, it will be 75% of the workforce. So millennials are becoming as important as the boomers were during the 70s until the 2000s. So whatever they like is what's going to be priced much higher. So that's important to consider when you look at silver and when you look at the short squeeze and whatever else you want to mention with it. I just don't see the feasibility of creating enough demand. And I know that the main the underlying fundamentals that people think about is they say, well, there's much more paper silver than there is real silver. And that's true. It's 100% true. It's also true for all the other commodities. All of the other commodities trade leverage because that's how the derivative paper markets in the futures work. It's the same with the ATMs, right? If the Reddit group says everyone now go to the ATMs and take your life savings out, then the ATMs don't have enough paper currency. It's about 16 to 1 from what I understand in most developed countries. The amount of bank savings compared to how much paper there's literally printed. So our system doesn't work that way. And the paper markets, these futures and the ETFs, etc., they're not built with the design of, hey, let's manipulate the price down. That's not why they're there. They're there because if you want to have a very robust market, and with a commodity, you're basically, what you really want with a commodity is for it to be as stable and as cheap as possible, because that makes our life much better. Those paper derivatives are what enables miners and banks and all of these individuals that are individual industrial uses, the 5,000 industrial uses of silver, to work in a global environment, because there are all sorts of instruments to hedge, etc. If you abuse those derivatives, that's what you get with what happened with JP Morgan, and I can name other banks that were involved, but JP Morgan is front and center because they got most of the heat for that one.
Yeah, I want to reiterate your special report. It's wealthresearchgroup.com/squeeze. Everybody should go check out that report. I agree with a lot of what you said in terms of what I was talking about this week was, I agree with you. I don't think going to SLV and bidding that up is going to be a way in order to squeeze, because of the way that SLV is set up in terms of a vehicle, its lack of access for the shareholders to silver. And I also think, reading what I was seeing in the market, this was like wave one of a renewed interest in silver. You mentioned the millennials. You and I have talked about the millennials before. It's the next generation that we all need to be paying attention to, because their buying habits are going to drive a lot of what we're talking about in commodities. And I agree. I think there's going to be another wave in silver as well as the overall commodities. So I wonder if you would talk about the next commodity boom and what you see there.
Okay. To me, Do you remember when the oil options expired and the price went negative in April of 2020?
Yes.
Well, to me, that marked the bottom for the 11-year bear market in commodities. Since 2009, institutional money, big money, retail money, hedge fund money, everything flowed toward tech. And so you had a very much a damaged and neglected natural resources industry. The capital expenditures for exploration, for M&A or mergers and acquisitions, for drilling, for development of projects, everything collapsed. And so the new economy boomed, so tech boomed, but you neglected the fact that, hey, if you want to run these Teslas, you need copper, you need zinc, you need silver, etc. If you want to have iPhones for 6-7 billion people, you need, cobalt and lithium, and etc., right? So I think that pivot happened in April 2020 because at that moment, the dollar was at its peak. There was about $30 trillion worth of stocks and bonds that were just liquidated in the March panic into the market. The dollar index shot up crazily. Commodities, I don't have to tell you what happened with silver, went to about $11.99, if I'm not mistaken, and like the 23rd, 24th of March, and then oil later on. So I think we have just begun a super cycle for commodities in general. And we start the super cycle with there are about 29 major commodities. 27 of them are at a deficit, an annual supply deficit. That is unprecedented. Only cocoa beans and zinc are not in a deficit. So what do you need for a super cycle? You need, one, the sentiment to be as awful as possible. Well, if you look anywhere, what are people talking about? AI, blockchain, cloud technology, telemedicine, all of these amazing technologies, and they just don't want to hear anything about commodities and about inflation. They think technology is overwhelming inflation, et cetera, et cetera. Then you have the second layer here, which the pandemic really proved, Robert, that people are fed up with globalization. They just reject it completely in 2020 because you had the most televised and the most communicated global crisis in history. We have never had a global crisis that was covered so simultaneously in all countries. And instead of the G20 coming together or the G7 coming together and creating some sort of a global passport, a global vaccine, how do we distribute these? How do we handle supply chains? How do we get through this together as a human race? No. Each country seceded, said, we're going to close our borders. We're going to handle it our own way. Every country had their own little niche. There was finger pointing and who's to blame for this. This is nationalism. This is not globalism. And what really happened is supply chains, because they're so delicate, because you're trying to create, as the global economy, you're trying to create the arbitrage of, hey, where's the best place to do this and where's the best place to do that? And we don't care if we need to manufacture the t-shirt in China, put the label on in Netherlands, and then sell it to America. If that's the cheapest way, we're going to do that. And in this global supply chain just showed how fragile it is in this kind of a black swan event. So what I think going forward is, you saw that with Trump, you're seeing it with Biden. They're both saying the same thing, made in America. They want to put manufacturing hubs around 90 to 120 minutes outside of these bigger cities like New York, Chicago, LA, etc., where you'll be able to either print, like 3D print a lot of the products, or manufacture them using robotics and AI, automation, etc. The arbitrage between the third world countries and the first world countries is really shrinking. So many of these poorer countries now earn $10, $20 a day. That's the arbitrages are getting they're getting shrunk to a point where it doesn't matter if you make it in Cambodia, it takes 3, 4, 5 days to put it on the container and come. People want the speed of delivery, and you can make it cheaper because you're taking labor out if you're doing it automated. I think that's where in the next decade you're going to see a lot of these things. And when you do that, then the price of the commodity could be higher, because gold, to mine gold in Nevada might cost more than to mine it in an unregulated environment like Peru or Brazil or China, where they don't have too many rules and environmental rules and ESG, etc., and they mine it cheaper. So commodities are going to go higher. Then you put all these restrictions on them, the regulations, all these environmental groups. I remind you, in the 70s, that they had a problem with acid rain. I don't know if you remember that. You had to take the sulfur out of everything. It raised the prices. Okay, so we have that. And we all know Biden's administration's hatred towards oil and anything polluted, etc. Obviously, that's going to raise the price of oil counterintuitively, because you're putting all these restraints on them, and cheapen clean energy. So that's one thing that we have to remember. The second thing is all of these redistribution of wealth programs and policies, stimulus checks, whatever you call them now, stimulus checks, or extended unemployment or boost unemployment. In 1 year, they will call them something different, and maybe they'll come to that day where they actually do call them universal basic income. It doesn't matter. What they're doing basically is they are trying to gap the wealth gaps. To shrink the gap of either the wealth inequality or the income inequality in America and in other nations by giving money to the poor or raising taxes on the higher brackets, etc. When these happens, as they did in the 70s, this creates inflation, because when you give money to lower income demographics, well, guess what? They're not going to buy stocks with it, and they're not going to buy real estate or bonds. They're going to spend it. They're going to create velocity. They're going to put it into the real economy. So you have that, and that's why I think inflation, where it is today, like the 1.5 officially, I would say it's going to go up by about 60%. So about 2.5%, which is above that Fed target of 2%. And I think they're going to let it run hot, as they call it. So they're going to try, they're going to allow 2.5%. Then you have all of these emerging countries that have seen in April and March of 2020 how powerful a dollar squeeze could be to their economies, how it can decimate their economies, and now they want to be more currency independent. So you're going to see a lot of these emerging countries trying to strengthen their own relative currencies, which obviously is very bad for the US dollar. You got fintech, which is making the dollar more and more irrelevant. And I think all of these combined are creating a super cycle in commodities. So to me, one of the most inversely correlated assets to the dollar or to dollar weakness is silver. And I think that will come into play. If you plot silver and the dollar, they trade like really inversely. One goes down, the other one goes up. You can look at it over 40, 50, 100 years. Gold, not so much. Gold can rally along with the dollar as a safe haven play. That happened many times in the last few years, where both of them just go higher or both of them go lower. Silver, very much inversely correlated. Silver is mostly correlated with oil. That's what really, that's how they really track each other. So I think oil prices will go higher, and silver in tandem. So I think those types of things, along with the fact that China is really trying to shore up their reserves. They want to have what the United States has, or what Russia had in the Cold War days. They want to have enough resources so that they don't have to bid for them on the open market. They just want to have enough of them. And so you've got this arms race for natural resources that's also very beneficial to the entire operation. Now, just in general, let's say the funds are picking up on this, the hedge funds, the sovereign wealth funds, the pension funds, and they start putting money into into mining equities. Well, how long does it take to turn this thing around, to put new mines into production? This is not tomorrow. It takes 2, 3, 4 years. This is a long bull market that we're going to see for commodities. And so, to me, silver, when it drops 9, 10%, 11% in a few days, that's a great time to, to raise, my allocation towards it. I like to buy these commodities after big pullbacks and not after big run-ups. But in general, that's the overarching thesis, and we put that in detail and everything in wealthresearch.com/squeeze.
Good points there. And I think you were mentioning a lot of things, like there are some commodities and supply deficit. Those may be some things that we want to target from an investment perspective if we believe, though, we're in this commodity super cycle, we're going to need more. As you said, China or Russia are going to need more. You have the Belt and Road Initiative that China is running to connect about 75% of the world's economies. That's going to need an incredible amount of resources. It's going to raise the living standards, I think, of a lot of the developing world. And it's going to, like you said, bring that arbitrage between the first world and the third world together. What do you think about this space economy and the march into space? Do you think that's an extension of what we're seeing here within the various domestic economies? And if so, how does that play into the commodities supermarket? I know silver is going to be a big part of that, but what else would you look at in terms of that march into the space-based economy and how that may affect the commodity super cycle as well?
You're talking about outer space?
Yeah, so the U.S. is setting up a space force. I think Ericsson and Nokia have been contracted to build 5G on the moon. That's been publicly reported in the press. So it looks like we're going to extend out into a space-based economy. I know India, for example, has put up thousands of satellites building their communications networks. So really, it looks like the race for space
Yeah.
between extending out into space and having that communications network that they're talking about, but also what that will do to the commodity sector as we begin to expand out from just like our domestic telecommunications networks.
Yeah. So not too far away. I think like 1 kilometer away from me lives the first Israeli
Hmm.
who just signed up. I think he's going to pay $100 million to go on SpaceX, and he's actually a fighter pilot in the IDF. He's 60 now, but he was a fighter pilot in the IDF. He's going to actually pilot this thing.
Wow.
Yeah, just you can Google him. I think his name is Eitan Stiva, and you can look him up. He's going to be the going with SpaceX, so with Elon Musk. For the meantime, what I did personally, if you go to our website to wealthresearchgroup.com, I don't know if you can show this on your screen, but anyways, there's a top menu button that's called watch lists, and those are basically PDFs that we've put together since April 2020 up until we released the last one we did was January 5th, and we're actually gonna exactly the watch list one, and we're actually gonna release another one next week. Now, a watch list is a group of stocks that we've put together in one PDF. You can download this, and it actually shows not only our research into it, but also my personal limit orders. So the price that I personally am waiting for these to pull back so I can buy them, and some of them have already pulled back, etc. There are about 55 different securities in these reports, and not only are all of them up because everything is up, but there were a few in there that that had to do with satellites and satellite technology. One of them from the October report is up 150% already. So I think it's a viable space. I don't know exactly how it will impact commodities. Near term, I know what it will do, but for sure, it's not a niche sector anymore. It's a big sector. You got some of the world's most powerful and influential people looking into it. It's obviously at its roots, so it's going through birth pains, but there are a lot of what you call ancillary. So the satellite industries that will benefit from this rush to space. All these technologies that have to do with how to power these stations and equipment and radars and whatnot. So I think those are more of what I would focus on at this point than trying to figure out who will build the first commercial rocket to space, etc. I would say that's, but it is putting a lot of interest into commodities because what they say is there's so much, whatever gold on Mars, whatever,
Mm-hmm.
right? That puts a little bit of a twist on it. I would say it that's what impacts commodities prices in the next few years. I think what's most important is the fact that the dollar is set to decline between 20 and 25% in real terms
Mm-hmm.
against a basket of major currencies. And I would say that, to me, is the number one reason to be long commodities at this point.
You mentioned earlier that we're starting the commodities bull cycle, and that I think you might have intimated that the technology sector may be a little bit long in the tooth. Did I get that correct? And if so, what's your thoughts on the technology sector?
Um, I think that if the Nasdaq has another year like the past 2 years,
Hmm.
then it will be long in the tooth, as you would say. Um, Actually, the GameStop and AMC, everything like that, what it did is it was a risk-off event. A lot of hedge funds had to change their positions, rebalance their portfolios, etc. I think a lot of the hype, the bidding up of prices and paying too much for the future, etc. That's not done by the hedge funds, but more by the retail public. They get excited about a certain technology, and they're willing to pay prices using what's called TEM, or a target market, the target potential market. So, for example, they would look at a company that sells um, foods that are vegan foods for millennials who love vegan foods, etc. And they say, okay, well, this company is only 500 million in market cap. Campbell's Soup, which isn't growing, is $20 billion, and therefore, what does it matter if this company is 500 million at this point, 600 million, 700 million, 800 million? It doesn't matter because its competitors are 20 times larger, and this one is growing at 50%. So even if I'm paying 150 times earnings, it doesn't matter, because next year, if it's growing 50%, I'll be paying only 75% and 30%, 30x, etc. So I think that is fueling a lot of these tech names to go much higher and much faster than their fundamentals. And when you buy shares of a company, you need to think that if Robinhood pulls the rug under you, but if, let's say, this company goes private, okay, how do you make money as an investor in a private company? Well, it's mostly depending on cash flow. This company making any profit or not? If you're buying a company for $1 billion because you think it's going to 2 billion, but it's making a few $100,000 in revenues, you're overpaying for a company. Now that can work in your advantage as long as there's a bull market, but in a sideways market or in a declining market, it just doesn't work. So what I focus on, I try to focus on companies that fundamentally are sound. They can be tech or otherwise. It doesn't matter. If you download like all of our watch lists, you'll see that there are many tech names in there, but they have done phenomenally well. Some of them have gone up well, one of them that we just profiled on December 1st is up 384% in
Hmm.
2 months. There are these companies out there that are fundamentally attractive,
Hmm.
that can go higher once the market understands their potential. I would choose not to chase these other ones higher at all. The ones that you see have already had like these hockey stick charts. On the flip
Hmm.
side, on I am one of those that likes to live and breathe the market, not to create a script in my mind of what I think is going to happen and just trade according to a script. I like to look at what's going on and say, okay, today what has the best relative value to me with the best risk adjustment. And that's what I will choose. So I am very bullish, for example, on real estate in the United States. You've got an entire generation, the millennials, who are hitting these peak earning years and are just not living in their own homes. They're not even married yet. And the inventory in the last 10 years has become so tight because everyone's so traumatized by 2008 that developers and contractors have not built enough units. We've never had a situation where the inventory is only 3 months worth of reserves. Usually it's between 12 to 18 months. We have a very tight real estate market with the lowest interest rates ever and with an entire generation whose credit is actually good. There are 30% more college graduates in the millennials than in Generation Y. So you've got a lot of things happening that that I think are really important. I'm sorry, in Generation X, and I think there's a lot of things that will propel real estate higher. Real estate has a lot of impact on the stock market. We've just had this 35% crash in 16 days in March 2020. In my opinion, that was a bear market, and we're in a bull market. It may have these in 21 a bubble, move, but I just don't see it. I think we've just entered a new bull market, both for equities and for commodities in tandem.
Great. Always wonderful to have you on the program, Lior, because you give us that broad view of the market that we always like to have and that our subscribers like. Lastly, before we go ahead and log off, just wanted to give us information on how people can sign up for your newsletter on Wealth Research Group and how they can contact you.
Yeah, definitely. Where it says email address right there, it says become an insider now. If you fill that in, it's our free newsletter, our own newsletter. And I think that's the best way to kind of see what we do all the time, because what I try and do is I try to congest the 6 to 8 hours a day that I do either reading or speak with CEOs or speak with fund managers and congest it into a 5-minute to 6-minute article that goes out 3 times a week. And then when there are specific opportunities, we even highlight and profile those.
Fantastic. Thank you, Lior, so much for joining the program. Like to have you on time to time. Appreciate all the feedback you gave us on equities, on real estate, on commodities, and silver specifically. Appreciate having you guys on. You guys stay tuned. We'll have more content this weekend. Stay tuned to the Gold Silver Pros channel. Thank you, Lior.
Thank you, Robert.